One vehicle that's been a popular way to invest for many decades is called mutual funds. And there's also exchange traded funds. And for people who don't want to spend too much time analyzing individual stocks, they could be an avenue to invest in the stock market while not having to do too much work. And you're able to still benefit from some mutual funds performance over time in the markets. You're listening to Investing Mastermind podcast. I'm Michelle Markey.
And I'm Signe and
So today we're talking about something that we don't usually talk about in the world of mutual funds and ETFs, just because there are some value to investing in these vehicles. And we want to help educate a little bit about the options in them. And if anyone's ever heard of an index fund, that's also a type of mutual fund. So today we'll talk about the pros and cons of each of these types of mutual fund like things. And we'll also touch on why they can be an attractive option compared to individual stocks sometimes. So with that, Sina, what do you know about mutual funds for our audience?
Well, mutual funds is not something I know very much about because that's a very American concept. We have something similar here in the Nordics, two mutual funds called investeringsforeninger. But it's somewhat of the same concept, but not 100%. So, but I do think that even though we don't have it here in Denmark necessarily, the things that we're going to talk about today is also going to benefit you because regardless of it's the American mutual fund or if it's any type of European equivalent, there's still something to learn from the concept of mutual funds. But I'm curious, Michelle, is that something you would invest in? Is it something you have done in the past? Maybe you're invested right now, something you would do in the future. Where are you on mutual funds?
Yeah, I actually have some, mostly through my work 401k. And before I get too far, I may not have explained fully what a mutual fund is. So, in a nutshell, it's basically a collection of stocks. So, a mutual fund means you have a bunch of stocks in it. There could be a couple of dozen to hundreds of stocks in a mutual fund, depending on what the fund manager puts in them. And yes, I own some because a lot of American 401ks only allow for Americans to invest in mutual funds in the 401k retirement options. So by default, either I can invest in those or I could put my money in cash, which is probably in another kind of cash type fund. So you can't really escape it if you're having a company mandated 401k unless the 401k allows you to pick your own individual stocks, which I think is somewhat rare. And our audience can correct me. Let me know if your 401k lets you pick individual stocks, but generally that's what happens. So I own some not because they're my favorite thing, but because they're the only option I have available through my 401k aside from cash or bond funds.
That makes total sense. I would say here in Denmark, there are certain people that are invested in different types of funds. Like, for example, you can go to the bank and the bank will tell you, oh, you should invest via our fund. And people will say, oh, yeah, sure, let's do it. And then just invest through the bank. And there are many, many different products which are similar. And the thing is that most people here, when they either let their pension fund or the bank administrate the money, is that they will have to pay a lot of fees. And the performance isn't necessarily that great either. So when people does it like that, it's because of the convenience, right? So it's people, they want to just have somebody manage their money. They've heard that getting into stocks is a good idea because just leaving them on a bank account and getting interest is, not that great. And especially back in the day where there was, especially here in Denmark, minus interest. So some people actually had to pay to have a savings account. And then a lot of people started just having the bank, for example, manage something similar to mutual funds. And the issue is the fees and that it might not perform that great. And because of the convenience, it often attracts people that don't want to look into every year, how did it perform? And then they go year after year and after year, and then maybe they're invested in a fund that doesn't really perform as well as the general stock market, right? And they have to pay a lot in fees. Like recent research, not only from the United States, but actually also from over here in Europe, shows that 45% of people's total returns are consumed by these funds. So 45%. You could have gotten that paid out, but instead you paid it in fees. That's a lot, and that's actually higher than it's ever been before. So
Wow.
now I'm just jambling. Please do stop me. Maybe you just want to you want to come in and say something, Michelle.
Wow, that's a lot in fees. And for sure, the mutual funds of the past were kind of like that too, where they ate up a lot of the return of retail investors like ourselves by having such high fees. And what that's referred to in mutual funds is the expense ratio. And there are two kinds. There's both the gross and the net expense ratio. And basically, the gross expense ratio includes all fees like management and administrative fees and marketing fees, compared to the net expense ratio, which includes trading costs and any reimbursements and waivers. So I don't know what all of that fully entails. So if you really want to dig deeper of what's the difference between these two, you can look them up. But often, a lot of mutual funds I've seen, they're very similar. Like the gross and the net expense ratios are not that far apart. So you want to just pay attention to both and know what they are to inform you how much fees are being taken out. But we've come a long way in mutual funds. They started becoming popular in the 80s, and my parents invested in some mutual funds for us when we were younger, and they had pretty mediocre performance like many mutual funds. Probably it would have just been better to invest in the S&P 500 index fund, which is a passive fund. So this is where I want to also touch on some of the difference between mutual and index fund, even though index fund is considered a mutual fund. So typically, mutual funds are actively managed by some manager who usually takes bigger fees. So you'll see a larger expense ratio with any actively managed mutual fund than a passively managed index fund like the S&P 500 index fund. And what you get for that is you get to invest in an index fund in, say, the 500 top companies in America in the S&P 500, and you have very low expense ratios like 0.015%, something like that. Don't quote me on that exact percent, but it could be extremely low, and you have to shop around. Like if you were to look at some of my YouTube videos in the past, I've talked about some index funds and mutual funds where I compared the difference between different brokerages and how much fees they offered at the time. Like maybe with something like Vanguard for the S&P 500 index fund, they charge 0.03% for their passive index fund. Compared to Fidelity, it was half of that. So in theory, maybe Fidelity has an even lower index fund expense ratio fee than Vanguard might, but it could have changed. So definitely look at that before you make any decision of investing through whichever brokerage in something like an index fund. But what's nice about an index fund is it's low fees, and you get to benefit as an investor from however America is performing in general. So instead of focusing on mutual funds where the manager can pick whatever stocks they want in that, like some of them focus in general areas, like some could focus in tech and some could focus in military and defense. You could find mutual funds that focus in these specific industries, or you could just pick the general index fund. So there are so many funds. And another one that's similar to all this is called an exchange traded fund, an ETF. And an ETF, you can invest in the S&P 500 with an ETF. It could be relatively passive, or you could have ETFs that are like mutual funds and they're in various stocks that they have. And the difference between ETF and mutual fund is an ETF is traded like a stock throughout the day, whereas a mutual fund is traded only after business hours. So once a day for the mutual fund. So that's why ETFs have gained more popularity, perhaps compared to a traditional mutual fund. So that's some of what we just wanted to share with folks out there. And the trade-off with an ETF is because you can trade it like a stock, it has more liquidity throughout the day. You might have higher expense ratio fees with that one compared to some mutual funds. It's not always that way. They could be almost the same, but you get somewhat of a trade-off for having more liquidity in an ETF.
Okay, well, that's very interesting because there are definitely some things I could hear that, is different from the US mutual fund and the Danish equivalent. Like, for example, here you can also trade it all throughout the day, and also that the expense ratio, the total expense ratio. So there's only one total expense ratio here, but that's much higher on the Danish equivalent to the mutual fund. That's like at least 0.5% more likely above. Whereas the ETF, as you mentioned, the exchange traded fund, and here in Denmark, actually, Danes just call everything fund. So sometimes it can be a little bit confusing. Here, are we talking about that kind of fund or that kind of fund? But with the exchange traded funds, the ETFs, it's the same here, right? With the low fees. But there is actually a difference because I believe it was in 2018, EU made a new law, and it was because there was a lot of sort of synthetic products within the ETF space. So a lot of derivatives or other kinds of synthetic products that was also traded through ETFs, and the EU wanted to sort of protect EU citizens. So now there's a law here that it's only ETFs that are regulated within the European market that can be traded in Europe. So we actually don't necessarily have access to the same ETFs as you guys have in the US. There are multiple sort of American funds that have now created European equivalents that are based in either Ireland or Luxembourg or somewhere like that. And we can now trade the exact same thing. So, of course, just because it's regulated by the European market, we can still buy, for example, the S&P 500 index, even though it's a European fund, because there's a lot of people that are asking me, okay, so since this law came about, can we only invest in European indexes like the DAX index in Germany or the OMX C25 in Denmark or similar indexes? And no, 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 we can still invest globally. There's even the Morgan Stanley Global Fund that we can invest in Europe as well. So I also want to say just that an index fund, it's actually an old concept. It was like in the 1800s that Charles Dow, who was one of the founders of the Wall Street Journal, he was looking for a way to sort of see how the stock market was performing or the American economy was performing. So what he did was that he took the biggest industrial stocks at the time, it was the industrial stocks and the railroads and things like that back in the day. And he took those and kind of made that index to see, okay, how are they overall performing. It's called the Dow Jones Industrial Average. And the Dow Jones is still an index that's actually also being followed by analysts and things like that. But now there are multiple of those index. And what you can say is that an index is like a hit list. So back in the day when I was young, you could see these hit lists in the music magazines and in the newspapers, and whatever was on the top of the list was the CDs or the tapes that was sold the most in the stores. And it's the same with these indexes, that it is the stocks that are just sold the most. So of course we have an index here in Denmark that shows which are the top performers in Denmark. There's on the London Stock Exchange in Germany, the most traded German stocks, the most traded global stocks, the S&P 500, which are the 500 most traded US stocks. So it doesn't say anything about whether or not these companies are quality or wonderful companies by what we think is wonderful, but it's just the things that are most popular, right? So
Yeah, well, it's good to know about all those options. So if you want to learn more about the world of mutual funds, index funds, there's a lot to learn. And the final moral of the story I want to share with the audience is to quote the famous Warren Buffett, the CEO of Berkshire Hathaway. And he said, most people should just invest in an S&P 500 index fund, and you can still benefit from low fees and still reap the rewards of whatever happens in the growth of American companies. So if you don't want to have to do too much research into individual stocks or other things, according to Warren Buffett, the S&P 500 is a pretty good bet if you believe in the future of America. And of course, none of what we say today is advice, but it's just what the best investor in the world is telling 90% of people to do is just try to focus on a low-cost passive index fund like the S&P 500, and you'll probably be okay. So, yep.
Yeah, exactly. What he says is consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin. So what that means is you should be consistent and continue to buy it. And through thick and thin, what he means by that is, sometimes the market as a whole increases and S&P 500 keeps increasing. The latest reports just came out last week that now we've reached a new high. So right now we're maybe through thick and later it might actually go down and we might be entering a bear market where the stock market, is defined by stocks will fall more than 20% from a previous high. So we might go into that, and that's the thin part, and that's where he really, especially through thin, so he really wants us to buy also the S&P 500 through thin. So before we end today, because we still have a few minutes left, Michelle, but I would like to talk about maybe some of the risks of buying mutual funds or ETFs. And we have talked a little bit about it in the past, like the concept of a lost decade, which is something that especially people that primarily focus on investing through funds will experience. Not people that are investing in individual companies will they can also definitely. We've seen it in the year 2000 with Nokia and Amazon and things like that, but it's more common to actually see with mutual funds or index funds and ETFs about the lost decade, right? So that's one of the risks about investing in a broader market fund.
Right. If you don't know what's happening with the market and you invested in these funds, and then if they go down, you might get scared and you might want to sell because you think, oh, the market's down. And that happens to a lot of people.
Yeah, absolutely. That's a risk too, because they take the passive approach that they don't know actually what is going on, and then they panic and they sell. Another thing I see quite a lot that's at risk in with people that are primarily using mutual funds and ETFs is that they're overexposed towards usually certain companies in particular or certain parts of the world. So what people that invest in funds, they like to have like that broad allocation across multiple different industries. But what I see is then they might buy, the S&P 500, then they buy the like a world fund, and then maybe a Nasdaq tech fund or something like that. And what they don't know is, well, they're overexposed maybe towards Nvidia or some of the tech stocks, like even some of the greener funds, the ESG funds, they are very popular around here in Denmark to buy some of those ESG funds. But what I see is in those funds, they have Microsoft, Nvidia, like some of those top performers to kind of pull that fund up. And then I just see that overexposure to certain companies, like those 7 very popular American stocks that we see also in the top of the S&P 500, and people actually being overexposed maybe to some of those companies because they are in so many of these ETFs and so many of these funds. So that's actually also a risk.
Yeah, for sure. So something to be mindful of when you see what are the top holdings of each of these funds.
There's actually this document, a fact sheet, a key investor document that you can read through. A lot of people, they tend not to read through it because there's a lot of words, there's a lot of different terminology, and they're like, but there's actually also a list of the key holdings in that fund that you can then read through and to make sure that you're not overexposed. So it's not dangerous to open that document. I know there's a lot of words in there, but try to overcome that and look at that list of which companies are they actually investing in this fund, and is it actively managed, is it passively managed? Things like that is also very, very important, because that actually, if it's actively managed, then you'll have to pay higher fees than if it's passively managed. So yeah, just some of the risks that people should be aware of when they buy ETFs and when they have that approach of convenience. It's still risky. Anything else, Michelle? We're getting towards the end of today's episode.
Yeah, I think that covers it as an intro to funds. And yeah, best of luck if you decide to invest in some of them. It's an option. We both like individual stocks more, but if you have to invest in them, at least we hope this is something that gives you a little bit more information behind them.
Yeah, absolutely. All right. Well, we'll be back in 2 weeks from now on Tuesdays.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.